Greetings, everybody. Welcome to the Liberty Call. Today is Thursday, February 8th, 2024. Hope you are having a fantastical day out there. It is a beautiful day here in Colorado. It is in the mid-40s. The sun's out. Sky's clear. I mean, there's a few clouds here and there, but I drove into town to get, run some errands just a few minutes ago, and man, it is just amazing. So anyways, I wish you were here. So if it is your first time watching Liberty Call, I'm glad you're here right now. If you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. You can see my boy Jake back here. He is itching to go out and play, and we'll do that as soon as we're done. So let's get to it. All right. Let's go ahead and get to today's numbers and see how the markets did. Let's see here. Dow Jones was up only 0.13%, 48 points, closed at 38,726. S&P 500 was up 0.06, closed at 49.97, just a hair off that 5,000 number everybody's been talking about. NASDAQ up 0.24%, closed at 15,793. The VIX was down 0.31% today. It's at 1279. Canada down 0.24, Brazil down 1 1/3, and Mexico down 1.56. European markets, Germany was up 0.25%, the UK down 0.44%, France was up 0.71%, the Netherlands up 1.64%, Spain up 0.17%, Italy up 0.28%, Switzerland down 0.64%, and Portugal down 1.12%. Russian exchanges both in the red today, the MOEX down 0.49%, the RTSI down 0.08%. And the Asian markets, the Nikkei was up 2.09%, Australia up 0.31%, New Zealand says flat, 0. In China, the Shanghai was up 1.28%, the Shenzhen Component up 1.29%, China 50 up 0.05%, DJ Shanghai up 1.35%, Hang Seng down 1.27%, and the Taiwan weighted was closed again. All right, so that is the markets for today. So kind of, nothing too high, nothing too low. So, but those Chinese markets have really bounced back in the last couple of days. So we'll wondering why the rebound. I mean, if everything's were so bad a few days ago or last week, why is what's with the sudden change? So, anyways, all right, let's go ahead and move over to the market recap. S&P 500 ends at record, briefly hits 5,000 for the first time ever. Woo! All right, the S&P 500 closed at a record high for the second consecutive Thursday, briefly touching an unprecedented 5,000 level before the close. Buoyed by a surge in Disney and ARM holdings, Disney soared over 11% after reporting better than expected fiscal quarterly results, announcing a 50% dividend hike and revealing plans for a $3 billion share buyback. The company's move into the gaming business with a $1.5 billion stake in Epic Games also contributed to the positive sentiment. ARM Holdings saw a 48% surge after exceeding Wall Street's current quarter guidance, fueled by a robust AI-led demand for its chip designs. However, not all sectors fared well, with PayPal leading the financials lower after falling 11% due to weaker than expected full-year earnings guidance. Ralph Lauren, on the other hand, surged over 16% following an earnings beat, earning a string of upgrades from analysts impressed by the company's performance amidst the current macroeconomic environment. Excuse me. The labor market continued to demonstrate strength with a decrease in the number of people filing for unemployment benefits, adding to a recent data indicating a robust labor market. This strength has complicated investor expectations regarding aggressive Federal Reserve rate cuts this year, with Richmond Fed President Tom Barkin suggesting that economic growth and a tight labor market give the Fed room to delay rate adjustments. Investor focus also turned to revisions in inflation data by the Bureau of Labor Statistics for 2023, aimed at providing a clearer view of inflation trajectory by filtering out seasonal effects. Fed Chair Jerome Powell highlighted the importance of these revisions in informing policy decisions, emphasizing the reliance on data over speculation. All right. So again, people at the Fed are, they're telegraphing that they're not doing anything soon on rates. This is my hypothesis here, is that they're probably waiting for something bad to occur, waiting for a market downturn, some sort of, black swan event or something to occur so that they could be the heroes like the Lone Ranger, ride to the rescue with, free money or, inexpensive money and, low interest rates, which again, it's kind of like shooting up heroin. You feel good in the moment, but after a while you're like, holy crap, I need some more. And, when there's no more money to print, then things, go cattywampus. Plus, you get a bunch of inflation from that. And I don't think anybody wants that right now. All right. I got some jobs data here. U.S. weekly jobless claims stay low despite high-profile layoff announcements. All right. The latest report from the Labor Department revealed a decrease in the number of Americans filing new claims for unemployment benefits, dropping by 9,000 to a seasonally adjusted 218,000 for the week ending February 3rd. This decline, which exceeded economists' expectations, expectations suggest ongoing strength in the labor market. Despite recent layoffs, particularly in the tech sector. The resilience in the labor market is supporting economic growth momentum for the fourth quarter into early 2024, potentially delaying anticipated interest rate cuts this year. Analysts noted that the data indicates minimal job losses with no significant signs of recession evident. Although there are a bunch of people out there saying we're in the middle of it right now. We just, the storm hasn't, rolled across the shore, and right over our heads yet, but it's out there. And, it's kind of like those first few bands of if you've never lived in a hurricane zone, you may not be aware of this, but, the storm will, the bands will come across, you'll get rain, and then it'll be clear again. And then another band will come across. It's not until the storm is right on top of you that, it's just nonstop weather. All right. While some states experience spikes in unemployment claims due to layoffs in specific industries such as construction, healthcare, and transportation, overall claims remain little changed compared to the same period last year. Financial markets have adjusted their expectations for the timing of the Federal Reserve's rate cut, pushing it from March to May as policymakers prioritize monitoring inflation trends. Despite high-profile layoffs, particularly in the tech and media sectors, there has not been a surge in initial claims, suggesting that many displaced workers are quickly finding new employment opportunities. Rising worker productivity and easing labor costs further support companies' decisions to retain their workforces. The sustained strength of the labor market is reflected in the declining number of people receiving benefits after an initial week of aid, indicating ongoing hiring activity. While there may be a slight uptick in claims as the economy slows, analysts do not anticipate a significant spike, emphasizing the labor market's continued resilience. Until it isn't. I mean, that's just kind of the way things are. Things are good until they're not good anymore. All right, and I got one more article here for you guys. This one comes from Zero Hedge. It's titled, Irony Alert, Outlawing Recession Has Made a Monster Recession Inevitable. So on one side, they're saying no recession. On the other, another article, they're saying it's going to happen regardless. All right. This article, authored by Charles Hugh Smith, delves into the prevailing belief that recessions can be entirely mitigated through monetary and fiscal stimulus, thus rendering them a relic of the past. Smith argues that recessions are not solely the result of economic financial factors, but are deeply rooted in human nature, specifically our inclination towards windfalls and risk-taking. It's kind of like the book by Hans Hermann Hoppe, Human Action, and he really dives into and I haven't read it cover to cover, I've read bits and pieces of it, but, essentially, it's the, humans' wants and needs are primarily what, drives, the economy or, really anything, whether or not it's, the economic system or just personal desires. It's, what people want, do you really want this, loaf of bread, or would you rather have, some money in your pocket? Well, if you're starving, you'll give up the money for the bread. So it's, it's kind of that give and take. All right. Over the past 40 years, policies aimed at preventing recessions have inadvertently created a bubble economy reliant on permanent stimulus. Yeah, like the 2% inflation we've been having that they want to have year over year. The normalization of low interest rates and, oh my Lord, my dog just broke wind and whoo, God, he is a stinky farter. The normalization of low interest rates and unlimited credit has fueled speculation mania and wealth inequality, leading to a dangerous dependency on bubbles. However, the consequences of this approach, including inflation and widening wealth gaps, are increasingly evident. Smith contends that the suppression of recessions has led to a complacency among the populace, who now expect continuous economic growth and intervention from central banks to sustain it. Yet beneath the complacency lie growing counterproductive dynamics that threaten stability, such as rising inflation and speculative bubbles. Moreover, the lack of experience with genuine recessions among those born after 1982 leaves them ill-prepared for economic downturns beyond the scope of government intervention. Smith warns that the normalization of perpetual expansion guarantees a severe recession in the future, as complacency and normalization of extremes sow the seeds of instability. In essence, Smith challenges the notion that recessions can be entirely eradicated, arguing that the attempts to do so have only exacerbated underlying issues and set the stage for a potentially catastrophic economic downturn. I wholeheartedly agree with that. I mean, it's, just inflating the bubble over and over again. It's going to lead to some bad times. And, if you're not prepared for it, you're going to get kicked in the nuts really hard. So, I mean, granted, my job as a financial planner is to make sure that my clients and, the people I work with are as prepared as possible for, all the events that, I can foresee. My saying I use is let's hope for the best and plan for the worst. Life usually falls between those 2 points. And, we can't plan for everything, but we can plan for the most common stuff. So, and, we haven't, we haven't really had a significant downturn. I mean, other than the little COVID recession, which we would have had a serious recession if they hadn't done all that stimulus, which I wish I had known it at the time. I would have made some other, financial adjustments to my portfolios, but, I don't get a heads up on what the Fed's going to do or what our government's going to do. So, anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to, hang on, banner up here. Please go to dsafinancialgroup.com. All my contact information is there. I hope you, like I said, all my contact information is there. If you need to reach me, please go to the website, and my phone number, email, and all that good stuff's there. Otherwise, I hope you have a wonderful evening. And if my dog would stop ripping gas down here, I might survive. So again, hope you have a wonderful evening, and I'll talk to you next time. Adios.